Good afternoon. The date is 8/6/2017. We have Tesla on a daily chart right here, and we're going to show it very quickly. Is that when Tesla had a big down move right here 3 days in a row, basically it was what we refer to a 20% correction off the daily all-time high. That yellow line is a 50-day simple moving average. Now here's the deal. You need to realize that when Tesla reported its earnings, the low here was exactly 311. We had the 315 calls. 2 days later, they gapped this thing up above that white line, and that's the 50-day simple moving average, so that everyone knows and whatnot, and that the downtrend reversal is above the 50. Now, one of the other things that we're going to do is we're going to show the weekly chart. The 10-week simple moving average on Tesla is above it at 347. That 20-week, which is a red line that's been rising, once it tested it, it had that big super pop. So 1, 2, 3, and the fourth week straight up. What's it contributed to? It contributed to the earnings that they had just released. And now there's a new bullish setup for the calls and the put options, and we're going to be covering that next. So that we have shown you so far how Tesla is setting up a new call and put strategy using call charts and put charts that 99% of option traders have never used versus a market making firm. So I'm going to put it on pause and I'm going to show one more. We have the monthly chart, and we can clearly see that on these monthly support and resistances that it has developed another new reversal trend involved. The next is to show the call charts and the put charts. I'm going to show you the daily call chart, which was right over here on 8/2 of 2017. We gapped up from $12.50 a contract, and we made a high on Friday, option expiration. They went from here to $43. 10 contracts would have made you $30,000+. And if you had 20 contracts, that's a $60,000 intraday. This is a $315 call chart. You can see it for real right here and right now. And it was contributed to a earnings release. So basically, when we take a look at the other end now, that we'll take a look at the $345 put, which is a put option that now has become totally deflated. So these put options on 8/2, they were $36.50 a contract on this put chart for August 17th. You can see now that they really took the premium out at 460. So one of the trades that we'll be looking at now, it's totally deflated versus inflated in the option pit. So once again, take the next right step, and we've already got that big gain on the call side. Here is the $350 daily put chart, and they gap down here to 464. And, you know, that's that same daily chart, but you can also see the fact that the $350 call went from here and it went straight up. Now, this side of the market is the cheapest side and the most deflated side in the put options. We encourage you to take the free 5-day trial. We encourage you to see the put charts and the call charts, inflated versus deflated, and we will be trading this tomorrow. And another one that we're going to be looking at tomorrow is going to be the $360 put option that was at $50 3 days ago, and now it's come down to $10.85. This is in the money 360 put chart that's totally deflated. This is the inflated part of Tesla call chart. So basically, when these call charts were inflated and they made these lows over here, everything was into play. This is the most deflated side, trading the earnings and buying those call options at the cheapest price that you could have bought them. Once again, call charts versus put charts. You option traders don't make decisions based on reality, and you have everything that's not in favor for you, but you do now. Take the next right step.